Welcome to another In Conversation. My name is Pierre Baron, Senior Investment Analyst here at Pitcher Partners Investment Services. Joining me today is Andrew Lockhart, Managing Partner at Metrics Credit Partners. Andrew is the co-founder of Metrics, a leading non-bank lender. He's here today to give us some insights on the private debt market and discuss the current market conditions. Thank you for joining us today, Andrew. For someone who is new to investing in private debt, could you give us a brief overview of what it is?
Sure. Private debt is really a reflection of the fact that the transactions that we enter into are confidential between a lender and the company that we lend money to. And so they're not exchange traded. Mm-hmm. So often with sort of public equities, or people buy and sell over the stock exchange, and they might buy and sell over a screen. In a private loan transaction, because they're confidential between a lender and a borrower, the information is quite sensitive because the lender uses that information to be able to assess and monitor the risk associated with providing that loan. And so loans tend not to be traded. They tend to be, if you're borrowing money for say 2 years or 3 years, we might provide the financing based on that requirement. So it's not traded, it's not public. The information, the loan terms, the conditions, the pricing, none of that is disclosed publicly in the market, and that's why it's a reference to private debt.
Could you give us some example of the type of borrowers coming to you?
Australia is very much a bank-dominated market, and so most Australian companies don't have credit ratings, and so they tend to be heavily reliant on the banks for funding. We don't have a big corporate bond market. And so when we established Metrics Credit Partners, we sought to provide our investors with diversification across the entirety of the market. And so that sees us lend to public and private large corporates. We're also very active in providing financing for acquisition purposes, which is really a lot of private equity firms that are going out and buying companies. We'll support them with financing. We're a significant lender to the commercial real estate sector, and that's primarily short-term development funding, again, primarily residential and industrial development activity. Project and infrastructure funding is a significant part of the market, and we also provide financing for large-scale project or infrastructure assets. There are a couple of other areas where we're active: structured credit, which is really providing financing to non-bank lending pools of assets, and also what we call fund financing. So really what we're looking for when we lend is to understand the company, the management strategy, what drives the cash flow to give us confidence that our borrower will service and repay their obligations to ensure our investors' capital is protected. And so we provide investors through our funds a range of vehicles to access the loan market, and we like to have diversification, not so much by way of industry, but more so in terms of the individual company or the project that we're financing.
And what would they come to you over a bank?
We believe very much at Metrics that we need to deliver a high level of service to our borrower clients, and we invest in long-term relationships with those clients. And the reason we do that is we believe it delivers a better investment outcome for our investor clients. And so for us, what we're looking to do is to really understand at a very deep level the company's activities, management, how we can assist with appropriate financing, but also we have a range of flexible mandates. So banks may only be able to lend, say, for senior debt. We have funds that can go from senior debt through to mezzanine or subordinated debt, all the way through to equity in the capital structure. And so we've got a range of flexible financing sources that allow us to be relevant. But I think one of the other things that borrowers are looking for is speed of execution. And so they're looking for a lender that can make the decision, understand their business, and provide them with certainty of funding. And so the way our funds have been set up, the borrowers in the market understand the risks associated with borrowing money from a non-bank lender such as Metrics. And we've been able to really overcome a lot of the barriers that have seen borrowers really go back and only rely on banks. So we see ourselves working with and competing against the banks to provide financing to a range of Australian companies.
In your credit process, what are some of the key criteria you assess?
For us, it all comes down to cash flow. What is the company's or the project's ability to generate sufficient cash flow to be able to service the interest and the fees, but also to provide for full repayment of the debt obligation at the appropriate time. And so it depends on the purpose for which a company is borrowing the money, and the risks will be different for each company. But one thing we try to do is avoid industries that are cyclical. So, if you think about some agriculture or natural resources type businesses, you can have a lot of cyclicality to their earnings, commodity prices, production volumes, foreign currency, weather, government trade disputes. It can all impact a company's ability to generate cash flow. So what we're looking to do is to find companies that have got very strong, stable cash flows, and that the earnings flow into the form of free cash flow that can service and repay the debt obligation to our investors.
What can you do to protect capital and mitigate some of the risks for the loans you're making?
Yeah, as a lender, it's very important that we really delve into what are the granular sources of cash flow that the company is going to generate. And by that we mean, how are they going to sell their product? What's management's strategy? And then once we understand that, we can structure the terms of the loan to mitigate risk. And so a lender would ordinarily have what we call covenants, which are undertakings that the company is given not to do certain things. So for instance, you may have a situation where you prevent a company from increasing its borrowing beyond a certain level, or what we would call, say, a debt to earnings or a debt to EBITDA covenant. You might have covenants that monitor and look at a company's ability to generate sufficient cash flow to service its interests. So you might have what we call an interest cover ratio or a debt service cover ratio. These are all designed to ensure that as a lender, you have an understanding of the risk profile of the company and that you can monitor any change in that risk profile over the term of the loan. As I said before, you can't necessarily buy and sell and trade out of a loan. And so the fundamentals of credit risk assessment is very important. And so we look at management strategy. We look at the industry that the company is involved in. What are the inputs? What are the sources of revenue? What are the inputs on costs? Has the company got a good reputation? Have management got a good track record? All of those sorts of things are very important to us in terms of assessing the company's viability to be able to generate the cash flow to service and repay the debt. And then as a lender, you might have other controls. So covenants might be a control. You might restrict a company from paying dividends to shareholders with that cash flow being required to repay and service a loan in priority. You might take security. So for instance, if it's a property transaction, you might take a mortgage over the property and all of the project assets. You might require personal guarantees from the directors. So there are a range of things that a lender does, but you make those decisions based on the risk profile of each individual transaction.
As the outlook, obviously, of the economy remains uncertain, could you give us some insights on how you manage a problem loan?
Again, it varies depending on the risk profile of each individual transaction and the way in which you might manage that. But generally, there are a couple of things that a lender might ordinarily look to do. The first thing is you monitor on a day-to-day basis the performance of the company or the project. You're trying to pick up if there's any deterioration to the fundamental drivers of cash flow. And so you're monitoring your covenants, you're monitoring the reporting. So often a company is required to produce a monthly profit and loss statement, a balance sheet, understand management, talk to management and the teams. And then what we're looking to do is identify if there's any deterioration. If there's a deterioration, then generally what a lender might look to do is, first of all, ask the company to raise additional capital from shareholders. So fresh equity. The purpose of that cash is to repay or reduce the level of outstanding debt. If a company doesn't want to raise fresh equity, it might be that they have to sell assets, and the company might sell property assets or sell a division of the company's operations to use those proceeds. It might be to restrict or stop paying dividend distributions to shareholders. Because what you're looking to do as a lender is that you've got priority over the cash flows, and so you want the cash flows to come to you to repay and reduce the debt. Obviously, it's important to talk to management and understand if there's anything that can be done in terms of their strategy. It may be that there's not, and the whole of the company is put up for sale or the property assets are put up for sale. In all of those cases, you're trying to preserve going concern value for shareholders, and you want to maximise the recovery value. So it's much better that companies take proactive action to manage that exposure rather than a lender enforcing. But of course, when you've got security, and if all of those things are deteriorating and company management and boards are unable to raise fresh equity or to sell assets to pay down debt, it may be that the company will be in default of its borrowing obligations, breach a covenant, or miss a payment. And as a result of that, a lender might take proactive action and enforce security. And so that might be the sale, mortgagee in possession, sale of a property, or it might be the appointment of a receiver to take that through. If things can be worked well and you can preserve value, you might be negotiating a consensual arrangement between the board and lenders. But in all cases, lenders are at the highest point in the capital structure. So shareholders' equity is obviously the part of the capital structure that is at greatest risk of loss. And so as a lender, you're wanting to ensure that equity is aligned before you are exposed to any potential risk of capital loss.
And for your current portfolios, could you talk about how the assets are performing, and are you seeing some sectors more challenged than others?
I don't have a view, I guess, in terms of some of the broader industry themes. What I do see is very detailed performance associated with the companies we lend to in our portfolio. Remember, we only do probably around 20% of the transactions that we see. So it's a high threshold in terms of will we lend or not lend to certain companies. And so generally what we've found is that most companies that we provide financing to are doing very well. Often our property clients and others are continuing to build successfully, complete projects, sales and the market activity, particularly in residential markets or industrial markets, have been very strong. We've stayed away from certain areas. When we look at a transaction, it's far easier to determine what the risk profile is at the time you're considering lending to a company than to have lent to a lot of different companies because you're looking for industry diversification only to be exposed to some downside risk. And so what we've tended to find is that most of the companies that we provide financing to haven't really been materially adversely impacted as a result of rising interest rates. But the way we managed that was, at the time of the pandemic, back in early 2020, or again when interest rates started to rise in May of 22, we took the view that we would rather reduce our risk by focusing on existing clients that have got a non-proven track record of performance. And so we've tended to skew our lending activities to those businesses, those companies, those projects, those developers that we've got an existing relationship with, who have demonstrated a track record of performance and have the capital and the financial wherewithal to operate successfully when business or economic conditions deteriorate.
Could you give us your outlook for the Australian private debt markets and what trends are you expecting to see?
What we see is continuation of the same sort of theme, which is banks continuing to struggle in terms of meeting the demand for credit and having a higher cost base associated with increasing regulatory pressure. And as a result of that, I think what we deliver for our investors is access to a very unique private market. I also think that what we deliver for borrowers is quite special as well, because we're delivering a unique source of non-bank financing to support their activities in the market, and that's valuable. It's a means to diversify funding risks for a lot of companies and projects. So I think from our perspective, we kind of continue to expect a continuation of the same theme. Importantly, what we've delivered for investors now over the last decade or so since we've operated as Metrics is consistent performance where we've delivered across all of our funds a minimum return in excess of the minimum target return that investors have been expecting. And we've done that by preserving and protecting our investors' capital through sensible and prudent lending activities. So from our perspective, we would be looking to continue exactly as we are, looking to originate good quality transactions with good quality counterparties or borrowers that we do business with, and to ensure that we're delivering appropriately for our investors.
Great. Thank you for joining us. Much appreciated, Andrew.
Thank you very much, Pierre.
Thank you for watching. If you want to learn more, please reach out to your Pitcher Partners advisor or check out the website, YouTube, or LinkedIn page.